Welcome friends to our channel. Give yourself a raise, where we help you make smart money decisions. In this video, we'll discuss the 7 key investing ideas from The Intelligent Investor by Benjamin Graham. This groundbreaking book, penned by the sage of Wall Street himself, has been guiding investors for over half a century. Graham's wisdom is as timeless as the markets are unpredictable. His insights, encapsulated in 7 key ideas, hold relevance for the greenest of novices and the most seasoned of Wall Street wolves. So whether you're just dipping your toe into the investment waters or you're a seasoned sailor, navigating the turbulent seas of the stock market, there's something here for you. Stay tuned as we delve into these 7 key investing ideas that could potentially change your investment game. The first key idea is the emphasis on long-term value over short-term gains. Picture the stock market as a wild roller coaster ride. It's full of ups, downs, twists, and turns. The volatility can be enticing, luring investors with the promise of quick profits. But Benjamin Graham advises a different approach. He suggests we put on our seatbelts and settle in for the long haul. Instead of being swayed by the market's daily fluctuations, Graham encourages us to focus on the long-term development of a company. It's about understanding a company's fundamental business principles, their history, their potential for growth. It's about becoming an intelligent investor who sees beyond the immediate horizon. Consider this: if you buy a stock today and it drops tomorrow, does that mean you made a bad investment? Not necessarily. If the company's fundamentals are strong and its prospects are bright, that stock could very well be a winner in the long run. This approach requires discipline and patience. It means resisting the temptation of quick profits and holding out for the potentially greater rewards of long-term growth. It's about seeing the value in a company's future, not just its present. So patience, dear investors, often pays the best interest. Moving on to the second key idea: analyzing before investing. It's crucial to understand that investing is not a game of chance, but rather a strategic maneuver that requires diligent research and analysis. The legendary investor Benjamin Graham advises us to analyze a company's long-term development and business principles before we consider pouring our hard-earned money into it. Take a look at the company's history. Is it steady and reliable, or does it fluctuate wildly? A company with a consistent track record is generally a safer bet than one that's all over the map. Also, familiarize yourself with the company's business principles. Are they sound? Do they align with your own values? These factors can have a significant impact on the company's future prospects. Another crucial aspect of analysis is understanding the company's future prospects. Where's the company headed? What plans do they have for growth? A company with a clear, achievable vision for the future is more likely to provide a return on your investment. But be careful not to get swept up in market trends or hearsay. Just because everyone else is investing in a particular company doesn't mean it's the right move for you. Investment decisions should be based on careful analysis, not popular opinion. Remember, an investment in knowledge always pays the best interest. So take the time to do your homework, to understand the company you're investing in, and to make an informed decision. That's the key to becoming an intelligent investor. The third key idea is understanding the difference between defensive and enterprising investors. Let's start with defensive investors. These are the individuals who prefer safety and minimal risk over high returns. Their investment strategy is usually quite conservative, prioritizing stable, high-quality stocks or bonds that have a long history of reliable returns. They're not the ones who will jump at every new investment opportunity. Instead, they take a slow and steady approach, protecting their capital and ensuring a decent return. On the other side of the spectrum, we have enterprising investors. Unlike their defensive counterparts, enterprising investors are willing to take on higher risk for the potential of greater returns. They actively seek out opportunities, constantly researching, analyzing, and forecasting market trends. They're not afraid to invest in lesser-known or volatile stocks if they believe these will yield high returns. So how do these two investor types differ in their strategies? Well, the defensive investor might utilize a buy-and-hold strategy, investing in well-established companies and holding on to these investments for the long term. Enterprising investors, on the other hand, might use a more aggressive strategy, like growth investing, where they invest in companies they believe have high growth potential, despite the risks involved. But remember, neither of these strategies is inherently better than the other. It all comes down to your personal risk tolerance, financial goals, and time commitment to managing your investments. So, know your investor type and invest accordingly. Our fourth key idea is the concept of margin of safety. So, what exactly is this margin of safety? In simple terms, it's a principle that involves purchasing securities at prices significantly less than their intrinsic value. This difference forms a safety net for investors, protecting them from poor decisions and unfavorable market conditions. Think of it as a buffer or a cushion that helps to absorb the bumps and shocks of the unpredictable investment world. It's like buying an umbrella before it starts raining, ensuring you're prepared for any sudden downpours. The importance of the margin of safety cannot be overstated in investment decisions. It's one of the cornerstones of a sound investment strategy. It minimizes the risk of loss by providing a measure of protection against errors in analyst judgment, market volatility, and unforeseen business or economic circumstances. However, it's crucial to remember that the margin of safety doesn't guarantee profits or completely rule out losses. It simply reduces the risk involved. And in the world of investing, anything that reduces risk is a tool worth having. So, how do you go about determining this margin? Well, it requires diligent research and analysis. You need to understand the company you're investing in and the fair value of its stocks. Then, you buy when the prices are below this fair value. Hence, a good margin of safety can be your financial life jacket. The fifth key idea we'll discuss is formula investing. This concept is all about creating a methodical investment plan to follow, rather than relying on gut feelings or hunches. It's like a recipe for your investment portfolio, where the ingredients are the amount of money you invest, the frequency of your investments, and the specific assets you choose. Now, why is this so important? Well, investing is not just about making profits. It's also about managing risks. And one of the biggest risks in investing is our own emotions. We may feel tempted to buy when the market is high and sell when the market is low, but this can lead to disastrous results. Formula investing helps combat this. By sticking to a set plan, we can take the emotion out of investing and make more rational decisions. It's a disciplined approach that can lead to more consistent results over time. Think about it like this. If you were on a road trip, you wouldn't drive without a map or a GPS, right? It's the same with investing. Without a clear plan, you may end up lost or worse, crash. Formula investing is like your map, guiding you through the twists and turns of the market. It helps ensure that you're investing consistently, regardless of market conditions, and that you're not letting your emotions get the best of you. So, let the formula guide your investment, not your emotions. The sixth key idea is learning from mistakes. Mistakes, as daunting as they may seem, are an integral part of the investment journey. Benjamin Graham, the author of The Intelligent Investor, was no stranger to this. He learned from his own missteps, transforming them into stepping stones for success. Graham emphasized the importance of learning from past investment mistakes. He believed that each error provides a unique opportunity to grow, to refine strategies, and to become a more intelligent investor. He highlighted that it's not about avoiding mistakes altogether. That's an unrealistic goal. Instead, it's about garnering wisdom from these experiences, using them as a compass to navigate the ever-changing landscape of the stock market. So, the next time you find yourself lamenting over an investment gone awry, remember Graham's advice. Embrace the mistake, analyze it, learn from it, and then move forward armed with new knowledge. Remember, mistakes are the stepping stones to wisdom in investing. The seventh and last key idea from the book is the importance of patience. In the fast-paced world we live in, patience often seems like a forgotten virtue. Yet, when it comes to investing, it's an absolute necessity. Benjamin Graham, in his wisdom, highlights this as one of the cornerstones of intelligent investing. Having the patience to wait for the right opportunity, to hold on to investments during market fluctuations, and to see long-term plans come to fruition is crucial. Impatience, on the other hand, is an investor's downfall. It can lead to rash decisions like buying high out of fear of missing out, or selling low during a market downturn. Such moves are usually detrimental to the overall portfolio performance. Remember, the stock market is not a sprint, but a marathon. It's about endurance, about staying the course, and about not being swayed by short-term trends. It's about understanding that the market has its ups and downs, but over the long run, it tends to go up. So, in the world of investing, slow and steady does win the race. And with that, we've covered the 7 key investing ideas from The Intelligent Investor by Benjamin Graham. We dove into the importance of long-term value over short-term gains, the necessity to analyze before investing, and the different strategies for defensive and enterprising investors. We explored the concept of margin of safety, the use of formula investing, and the importance of learning from our mistakes. Lastly, we emphasized the vital role patience plays in successful investing. If you found this video useful, please leave a comment below and let us know what money topics you'd like us to cover next. Until then, happy investing.